Management Accounting, Sarma Gupta. This book is useful for the management lesson. Journal, ledger in tally, and then voucher, sales, Sunday ledger, Sunday creditors, and then purchase, sales, cash, bank, all entries entered in the tally, and also useful for the management decisions. Nature and scope of management accounting. Financial accounting is the concern with reporting transactions and preparing financial and other reports to be listed used internally by management and externally by investors, creditors, potential investors, and government agencies. Management accounting is, on the other hand, is primarily concerned with providing information for use by people within the organization. And then meaning of accounting. Accounting analysis, the collection, recording, classification and presentations of financial data for the benefits of the management and outside agencies such as shareholders, creditors, bankers and government. The word accounting can be classified into three categories: financial accounting, cost management accounting. Meaning of financial accounting. Financial accounting may be defined as the science and art of recording and classifying business organizations, business transactions, and preparing summaries of the same for determining and profit and loss and the financial position of the concern. So profit and loss and balance sheet is maintained by the accounting. Functions of financial accounting: recording of information, all recorded information, and classification of data or classifications, and making summaries, dealing with financial transactions, interpreting financial information, communicating results, making information more reliable. All entries are available functions of financial accounting. And then accounting concepts, accounting principles, accounting concepts, and then accounting conventions is the classified. Accounting concept: business entity concept, going concern concept, the cost concept, and real aspect concept, money measurement concept, accounting period accrual concept, realization concept, matching of cost and revenue concept, accounting conventions, conventions of disclosure, convention of consistency, convention of reservation, convention of materiality, and limitation of financial accounting. Limitation various limitations of financial accounting. Historical nature provides information about the concern as a whole and net helpful in price fixation, cost control not profit, cost control not possible, operation of policies not possible, only actual cost recorded, and cannot helpful in taking strategic decisions, technical subjects, quantitative information, lack of unanimity about accounting principles, chances of manipulation, making financial accounting useful to management, up-to-date accounts and internal reports to be prepared, making comparison of financial statements. These are accounting and information system. Information is of management, information is of shareholders and investors, and information need employees, information need of creditors, information need of government. Cost accounting, meaning of cost accounting. Costing is the specialized branch of accounting. It has been developed because of limitation of financial and accounts. In the present day, it is absolutely necessary that a business concern should operate in the activities with almost efficiency and lowest cost. Meaning of costing and cost accounting. The term cost has a wide variety of meanings. Different people use this term in different senses for the different purposes, and then other functions of cost accounting: analysis and assessment of cost, presentations of cost for cost reduction and cost control, planning and decision making, importance and advantage of cost accounting. Cost accounting as added to management and advantage of employees, advantage of creditors, investors, bankers, advantage to government and society. Annual report is given, and also it is the shareholders. Limitation of cost accounting, management accounting. Management accounting, cost accounting, management decisions for flow of statement, ratio analysis, and cash flow analysis. Management accounting. Meaning and emergence of management accounting. Management is comprised of two words, management and accounting. It is the study of managerial aspect of accounting. The emphasis of management accounting is the decision accounting in such a way that it is helpful to management and formulation of policy, set the control of execution and appreciation of opportunities. It is the system of accounting which helps management by carrying out its functions more efficiently. Represents of management accounting. Anglo-American Council and Productivity, these are the various others are represented in the management accounting. Characters or nature of management accounting, providing accounting information, causes and effect analysis, and use of special techniques and concepts, and taking important lessons, achieving our objectives, and no fixed norms followed, increasing efficiency, supplies information and not decision, concerned with forecasting, scope of management accounting, financial accounting, cost, financial management, budgeting and forecasting, inventory control, and reporting to management. These are under control procedure and methods, and internal tax accounting, office services. These are available in the scope of management accounting. Activities of management accounting, planning and policy formation, helpful in controlling performance, and helpful in analyzing, helpful in interpreting financial information, motivating advice, helpful in making decisions, reporting management, helpful in coordination, helpful in tax administration, functions of management accounting, planning and forecasting, modification of data, financial interpretation, finance facility management control, and communication, use of quantitative information, coordinating, helpful in taking strategic decisions, supplying information to various levels of management. Relations of management accounting with financial accounting. Object, nature, subject matter, compulsion, precision, reporting, description, recognition, accounting principles, period, and publication, audit. Relations between cost of management accounting. Object, scope, nature, data used, development, principle followed, management accounting conventions, tools and techniques of management accounting, financial policy and accounting of financial statement, historical cost accounting, budgetary control, standard costing, marginal costing, decision accounting, devaluation accounting, control accounting, MAS, management system, need and importance of management accounting, increase efficiency, proper planning, measurements of performance, maximization profitability, improve service to customers, effective management control, limitation of management accounting, based on accounting information, lack of knowledge, immediate decisions, not an alternative to administration, on top heavy structure, and evaluation, personal bias, psychological research, on limitations of management accounting completed, and management system is now. And management accounting is the head of the management accounting. Functions of management accountant, planning for control, reporting, evaluating, administrative tax, available operation of external effects, protection of assets, all. Other duties of management accounting, collection of information, evaluation of information, interpretation of information, or reporting of information, other controller, organization for management accounting. Contemporary emergency issues in management accounting, value chain analysis, activity-based costing, quality costing, and total quality management, cost of prevention, cost of conformation, cost of operational, cost of non-conformation, cost of internal failure, cost of external failure, and cost of lost opportunities, target costing, lifecycle costing, just-in-time inventory control is common question. Financial analysis. What is financial analysis? The financial statement is the collection of data organized according to logical and consistent accounting procedure. The purpose is to convey an understanding of some financial aspects of business firm and position in moment in time as in the case of a balance sheet, and may reveal a series of activities over a given period of time. Nature of financial statements. Recorded assets, recorded facts, accounting conventions, postulates and personal judgments, and an appeal financial statements, and types of financial statements, balance sheet, income statement, statement of changes in owner's account, statement of changes in financial position, balance sheet, and form of control of balance sheet, control the balance sheet and also take the decisions. That is explanation of balance sheet, identify capital, resources and surplus, secure loans, unsecured loans, current liabilities and provisions, asset sale, fixed asset investment, organization, miscellaneous expenses, form and conveyance of income statement, non-budgeting account, profit and loss account, here's the ideal financial statements derived, where is the importance of financial statement, management, creditors, bankers, unlimited stocks, government, trade, association, stock exchange, various of financial statements, one in three reports, do not give exact position, historical cost, impact of non-monetary items, no precision. These are one of the financial statements. First time stands out is over financial statement analysis, meaning in concept of financial analysis. The term financial analysis is the known as analysis of financial statement. Refer to the process of determining financial statement weakness of the term by establishing strategic relationship between the items of the balance sheet, profit and loss account, and other operating data. Other is importance of financial statement analysis. Parties interested in the financial analysis, types of financial analysis, on the basis of material, external analysis, internal analysis, on the basis of models operandi, on header analysis, particular analysis, on the basis of analysis on cross-sectional, on the inter-firm analysis, time series and intra-firm analysis, on the basis of third version and objects of analysis, analysis, procedure of financial statement analysis, methods of devices of financial statement analysis, proper statement analysis, commercial statement, funds flow analysis, cash flow analysis, relationship, cost-value profit analysis, comparative statement. The comparative financial statements are statement of financial position and different periods of time. Comparative balance sheet analysis is the study of the print of the same item, group of items, and comparative two or more balance sheets in the of the same business enterprise have the different data, dependents. Comparative balance sheet. Comparative balance sheet is 2 years balance sheet is given. Comparative balance sheet is already 2007, 2008. Absolute change, percentage change. Answer. Assets, liabilities. 2007, 2008, 2008. Change of 2010, 7, 2008. And then percentage is calculated. And then comparative income statement. Sales, cost of goods sold, indirect expenses, rate of income tax. These are information 2007, 2008 is given on comparative income statement of Java Limited. Sales less cost of goods sold, gross profit less indirect expenses, profit before tax less income tax, net profit after tax calculated 2007, 2008. Absolute change, change of the in the for 2008, 2008 percentage is calculated, and then comparative balance sheet. Current assets, prepare comparative statements of the following data, comparative statement of the following data, income statement, balance sheet. This information is given, comparative income statement, comparative balance sheet information is given. Income statement. Commerce is income statement. So net sales, less cost of sales, gross profit, operating expenses, salary and distribution, administrative expenses, total expenses, operating income, other income, total income, non-operating expenses, net profit during the year less 2006, 2007, 2006 rupees, percentage value 2007 rupees, while percentage value is calculated as the common size income statement. And then trend analysis is the problem is given and given answers. Common size income statement, common size statement, common size balance sheet is given. Also common size statement is used. Common size balance sheet amount X go, Y go, amount percentage, reserve current assets, share capital and reserves, current liabilities is given, and amount percentage is given, and answer is right. Common size income statement. Sales, business income, cost of sales, office expenses, selling expenses, interest, net profit. This available information 2006, 2007. Common size income statement. Sales, cost of sales, profit, gross profit. So 2006, 2007. Percentage is given, used, and percentage is on then calculated. And then common size balance sheet. 2 years is given. So answer the current assets, fixed assets, and current liabilities is and then fixed liabilities and amount percentage of total 800 billion and then answer. And then this is a financial statement analysis. And theory is also available. So and then ratio analysis. Ratio analysis is one part. A ratio is a simple arithmetic expression of the relationship of one number to another. It may be depend as the indicator question of two mathematical expressions. Nature of ratio analysis. Ratio analysis is taking a financial interpretation of financial statement. It is a process of observing and interpreting various ratios for helping in the making certain decisions. Interpretation of ratios. Interval ratios can be made in the following ways: single ratio, group of ratios, historical comparison, projected ratios, inter-firm comparison, values of the proportion for the ratios, accuracy of financial statements, ability of proportion difference, turn of ratios, use of standards, and caliber of the analysis. Ratio provided only base use and significant ratio analysis. Manage the ratio analysis, helpful in decision making, and helps in planning, helps in communicating, helps in coordination, helps in control other peers. It is of shareholders, investors, it is of creditors, and it is of employees, it is the government and tax requirements. Is the use and significance of ratio analysis. Limitation of ratio analysis, limitation use of single ratio, lack of adequate status, incurrent limitation of accounting, changes accounting procedures, window dressing, person bias, uncomparable, object bias, destructive, price level changes, ratios and appears, those not conclusions. Classification of ratios, traditional classification or statement ratios, classification of ratios, balance sheet ratios, profit or loss account ratios, composition and mixture ratios, current ratio, liquid ratio, RSC ratio, quick ratio, affiliate liquidity ratio, debt equity ratio, property ratio, and capital carrying ratio, asset property ratio, capital inventory or working capital ratio, ratio of current assets and fixed assets, and profit and loss account ratio, gross profit ratio, operating expense ratio, operating profit ratio, net profit ratio, cash profit ratio, expense ratio, interest coverage ratio, and composite method, interest rate ratio, stock turnover ratio, and debtor turnover ratio, liability turnover ratio, and fixed asset turnover ratio, return on equity, return on shareholders' funds, return on capital employed, capital turnover ratio, working capital turnover ratio, return on balances, return on profit ratio, total asset turnover ratio. This ratio and also calculated answers. Current ratio, current assets, current liabilities. Current assets, current liabilities is given, current ratio calculated. And then quick ratio. Quick ratio is calculated by the quick assets by current liabilities. Quick assets, current liabilities is given and also issue. This information is given. And then auxiliary liquidity ratio, auxiliary liquidity assets, current liabilities. Then inventory turnover, stock turnover ratio. Inventory business of dependency interval ratio. Interval business quick or liquid asset by our daily cash operating expenses. And then inventory turnover ratio, cost of goods sold, our inventory at cost. And then inventory turnover ratio, inventory conversion period. These are used on a formula also the answers. And then debtors receivable turnover or debtors velocity. Debtors turnover velocity, net credit and sales by average trade debtors. Average transaction period, average trade debtors plus bills receivable by sales per day. These are all the is for the ratio analysis. On a credit card, payable analysis, net profit, net credit, and the purchase average debtors. All ratio analysis all used, and then on a calculated answers. Debt equity ratio. Fixed assets ratio. On a gross profit ratio, profit ratios, calculation of formulas, and then limit of turnover ratio, all these formulas and also given the answers. Completed ratio analysis, and then statement of changes in financial position, funds flow statement. Funds flow statement is the statement which shows the movements of funds and export of financial operations of the business undertaking, meaning and concept of funds in narrow sense, in a broader sense, and in a popular sense, and meaning and concept of funds, flows of funds, current and non-current accounts. Meaning and definition of funds flow statement. Funds flow statement is a method of which we study changes in financial position of the business or enterprise beginning and ending financial statements. It is a statement showing sources and uses of funds in a period of time. Fund flow statement, income statement, balance sheet, use and significance and components of fund flow statement. It gives in analysis of financial operations throughout making many perplexing questions and general interest. And government foundation gives a proper allocation of resources. It acts as a basic guide and it helps in appraising the place of working capital. It helps in knowing all greater work clearness of the firm. Remedies of funds flow statement. Procedure of funds flow statement. Procedure for preparing funds flow statement. Statement of changes in working capital. Balance sheet is given. Statement of changes in working capital. Statement of changes in working capital. 2006, 2007. Effort of working capital increase, decrease. Current liabilities, current assets, current liabilities. And then current assets, current liabilities less. Working capital net decrease in net decrease in working capital calculated. And a source of statement of reimbursement funds flow statement. Source of funds flow statement formula method. Source of funds flow operations, steps are raising of long-term loans, receipts from party paid shares per column, sale of non-current passive assets, non-trading receipts such as dividends interest, sale of investments, long-term, decrease in working capital, as per schedule of change working capital total obligations, use of funds for last operations, reduction in preference share capital, reduction in debentures, repayment of long-term loans, purchase of non-current assets, purchase of long-term investments, non-trading payments, payments of dividends, payment of tax. Payment of dividend and tax will appear in the application funds on which these items are appropriation of profit and loss, profit and not liabilities. Funds for statements, sources, applications. Calculate and give the answers. Calculate the funds from operations. Profit and loss account problem is given. Calculate the funds from operations and adjust the profit and loss account. And then P&L is given. Calculate the funds from operations. Use the method and use the calculate the funds from operations. And then funds flow statement, cash flow statement is important for the management revenue, marginal costing, reserve, and then funds flow statement, cash flow statement, and theory are available in question paper. Funds flow statement, 2 years is given, liability assets, schedule of changes in working capital, funds flow statement, share capital, plant and machinery, goodwill, adjusted P&L, all calculated, and then cash flow statement. Cash flow statement. Cash plays very important role in the entire economic life of the business. Meaning, cash flow statement is a statement which is discussed the inflows and outflows, sources uses of funds. Cash flows from operating activities, cash flows from investing activities, cash flows from financial activities. Table of some type items, extraordinary items, interest on the dividends, taxes on income, acquisition or disposal of subsidiaries of other business units, foreign currency cash flows, non-cash transactions, format of cash flow statement. And then comparison of cash flow statement, cash flow statement, cash budget, cash flow statement method is used and also give the answers. Cash flow statement is useful for the sources and the use the book and also give the answers in the cash flow statement. Funds flow statement, cash flow statement is the available in question paper. And then marginal costing. And then budgeting and budgeting control. Concept budget, sales budget, production budget, master budget, question is coming in the assisted sales budget and production budget question is available. Thank you, welcome. Thank you, welcome.